Welcome to the Deep Dive. Today, we're tackling what has to be one of the most critical earnings reports in the cybersecurity space, Zscaler's Q1 for fiscal 26.
Absolutely. This is the one everyone was watching. Zscaler is, sort of the benchmark for high-growth security, right at that intersection of zero trust and now AI security. The expectations were just stratospheric.
And if you just look at the raw numbers on paper, they absolutely delivered.
They really did. A definitive beat.
Revenue came in at $788.1 million. That's well above guidance, well above what analysts expected, and it's a solid 26% growth year over year.
And on the bottom line, too, non-GAAP EPS was 96 cents when the street was looking for, 86 cents? So about 25% growth there as well.
So every box checked. But this is where we get to the massive paradox of this whole report.
Right. The strong fundamentals, the beat, it just didn't matter to the market. The reaction was, well, it was violent.
Violent is the only word for it. The stock just saw this incredibly heavy selling volume the next day. It ended up dropping 13.0%.
Which is just staggering when you think about it.
It really is. The options market was only pricing in about a 6.3% move up or down. So the actual drop was double, literally double the expected volatility.
And that tells you everything you need to know about the current environment. For these premium stocks, there's just zero room for error.
So let's get into that, because before we talk about the guidance, which is what the market focused on, we have to look at the business execution itself. I mean, the metrics were just elite.
Genuinely rarefied. Forget the rule of 40, which is already a high bar.
Yeah.
Management was talking about operating at the rule of 78.
Okay, the rule of 78 sounds kind of insane. Can you just break that down for us?
Sure. So the rule of 40, as you know, is your revenue growth plus your free cash flow margin. To get to 78, Zscaler combined their 26% revenue growth with an exceptional 52% free cash flow margin.
52%.
52%. That's $413.3 million in free cash flow for one quarter. That's the kind of operational leverage that puts them in a very, very small group of companies.
And that's fascinating because they're doing this while still reporting a GAAP loss, right? It was about $11.6 million. And they even mentioned gross margins ticked down a little bit.
A tiny bit, yeah, from 81% down to 80%.
So how does that work? Isn't that the classic trade-off where you invest for growth and then the margins suffer?
It's a great question, but here's why it worked for them. The FCF is so high because it's a cloud service model. There are no huge capital expenditures. And that tiny dip in gross margin, it was intentional. They said they're prioritizing getting new products to market faster. So they're trading 1 point of margin now for what they see as a massive strategic lead later.
So they expect to optimize that back up once those products get to scale.
Exactly. And the 52% FCF margin proves that their spending is already incredibly efficient. It's why they can say they're one of only 5 enterprise SaaS companies with over $3 billion in ARR that are still growing north of 25%.
Okay, let's talk about those runway metrics then, the signals for future growth.
Right, because they look even stronger. Yeah. So ARR ended the quarter at $3.2 billion, up 26%. But the key number, the one to watch, is RPO remaining performance obligation. That grew 35% year over year to $5.9 billion.
And RPO, just for everyone listening, that's basically the total value of all their signed contracts for future revenue.
It is. And when you see RPO growing that much faster than current ARR, it's a huge leading indicator. It tells you that customers are signing bigger deals and for longer terms. They're confident.
And about half of that is current, right? So it's coming in over the next 12 months.
47% of it, yeah.
Yeah.
The visibility is just tremendous.
Which you can only get if the sales engine is really humming. This seems like a good place to pivot to the strategic pillars they talked about. There were 3. AI security, zero trust everywhere, and data security everywhere.
Exactly. And let's start with Zero Trust Everywhere, or ZTE. This is their big platform play for their largest clients. They had a goal to get 390 enterprises on the ZTE platform for the whole fiscal year.
And they just smashed it. They did it 3 quarters early, and they're already at over 450.
The impact there is huge. These ZTE deals covering users, branch offices, the cloud, these are the massive multi-year 7- and 8-figure wins. This is where they're literally ripping and replacing legacy firewalls and VPNs.
It's a whole paradigm shift.
It really is. And they flagged this one massive tailwind that's driving a lot of this.
The SAP RISE migration.
The SAP RISE migration. Management actually compared it to the tailwind they saw years ago with the Microsoft O365 migration. It's that big.
And why is that so important?
Well, think about it. SAP systems handle a company's most sensitive data. As you move that to the cloud, you can't just put a firewall around it anymore. You absolutely need a zero-trust architecture, and Zscaler is just perfectly positioned to capture all that new demand.
Okay, so that's the foundation. But the area that's really accelerating, the one that got a lot of attention, was AI security.
That's the explosion. I mean, their AI security ARR is already over $400 million.
And growing how fast?
More than 80% year over year. They're on track for it to be over $500 million by the end of the fiscal year. This isn't just a feature, it's becoming its own standalone high-growth business.
And they're building out a full stack for it, too. They mentioned a few things: AI asset discovery, AI red teaming from their SPLX acquisition.
And AI Guard, which sits between your applications and the LLMs to enforce policy. And this isn't theoretical. The platform is already securing over 90 billion AI and machine learning transactions every month.
So the recent acquisitions, Red Canary and SPLX, they're not just buying revenue.
Not at all. They're buying key technology to become a full-stack, zero-trust plus AI security platform. It's a really complex and ambitious build-out.
And the third pillar, data security everywhere, how does that fit in?
It's the connective tissue. It basically makes sure data is safe, no matter where it is or who is accessing it, especially with all these new Gen AI tools creating new risks for data leakage. It's the piece that ties it all together for their big, regulated customers.
So you have these amazing products, these big strategic wins. How do you actually get customers to adopt them faster? That brings us to their commercial engine, Z-Flex.
Right. Z-Flex is just brilliant. It's designed to kill the friction in enterprise sales. It's a commit and swap model.
So a customer commits to a big chunk of money up front.
Exactly. They get the budget approved one time. And then their security team can just turn on new modules during the year, like identity threat detection, without having to go back through that whole painful procurement cycle again.
Which must just dramatically speed up the sales cycle.
Massively. And the data shows it's working. Z-Flex generated over $175 million in contract value this quarter alone. That's up more than 70% from the previous quarter. It's how they're landing these huge 8-figure deals.
It really is a flywheel. Okay, so business is strong, the products are winning, the commercial model is working, which brings us back to that 13% drop.
Back to the sell-off.
They did raise their full year guidance. They raised ARR, they raised EPS up to a range of $3.78 to $3.82. So why on earth did the market hate a guidance raise?
This is the absolute crux of it. It all comes down to what investors call the guide delta. The problem was that the amount they raised the full year revenue guide by was actually smaller than the amount they beat the revenue estimate by in Q1.
Ah, and for these high growth stocks, the expectation is that you pass through most, if not all, of the beat into the full year guide.
100%. And when they didn't, the market took it as a signal. Either management is being too conservative, or maybe they're worried about growth slowing down later in the year.
And that uncertainty, combined with the premium valuation and the ongoing GAAP losses, was just enough to trigger the sell-off.
It triggered aggressive profit-taking. You also had some M&A integration risk priced in around Red Canary and SPLX. It was a perfect storm where the short-term optics, the math of that guide delta, just completely overshadowed all the long-term operational success.
Which explains why the drop was double what the options market expected. It was big institutions repositioning.
For sure. It just shows when you're flying this high, there's no margin for ambiguity.
Okay, so with that, we're now entering the segment we call This Is Not Financial Advice. This is where we pitch an outrageous but plausible trade idea based on exactly this kind of divergence.
And the divergence here is pretty extreme. You have a company executing at the rule of 78, which is almost unheard of, but it's suffering this violent multiple compression because of an optics issue. The stock has, you could argue, been fundamentally de-risked by an overreaction.
So what's the pitch?
The pitch is to look at a leveraged long position, maybe something like long-dated call options looking out 12 months. The sell-side analysts still have price targets in the $330, $340 range, which is over 30% upside from here.
And the thesis is basically that the 13% drop was just a massive overshoot.
It's an overshoot. It gives you a de-risked entry point into a leader in AI security, a market with a 30% plus growth rate and zero trust, with a 16% plus growth rate. You're buying a best-in-class asset at a discount because of short-term sentiment.
What are the catalysts you'd need to see for that trade to work out?
It's all about continued execution. First, that AI security ARR needs to keep accelerating and blow past that $500 million mark. Second, they have to show that the Red Canary and SPLX integrations are successful. If they do that, then in a future quarter, The guide raise will be bigger than the beat, and that'll signal the conservatism is over.
A really compelling idea built on that clash between Wall Street's short-term focus and the company's long-term execution.
That's the whole game right now.
Okay, let's do a quick recap. Zscaler delivered incredible growth, 26% revenue, Rule of 78 performance. They have huge strategic wins with zero trust and an exploding AI business. But the stock got hammered because of conservatism in the guidance.
Right, and when you look at the long-term picture, cybersecurity spending is projected to hit something like $323 billion by 2029. Zscaler is attacking the fastest-growing parts of that market, so the debate isn't about the business model. It's purely about valuation.
Which leaves a big question for you, our listener.
Is the stock now sufficiently de-risked after that 13% haircut? Or does that premium multiple, even now, still leave too little room for error?
A great question to end on. And remember, that entire last segment was our outrageous but plausible trade idea. It is absolutely not financial advice. We'd highly encourage you to go look into the mechanics of that Zflix program and the sheer scale of the SAP Rise opportunity for yourself. That's it for this deep dive. We'll see you next time.